Back. In this video, we will reverse engineer the abnormal earnings growth model. We will infer the implied cost of capital and investors' expectations about long-run growth in abnormal earnings growth and long-run growth in earnings. So far, we have been using the abnormal earnings growth model to estimate the value of a firm's equity. The price and the valuation formula was our unknown, and we were using estimates of future earnings, future abnormal earnings growth, long-run growth rates, and the cost of equity capital to calculate the price. In this exercise, we will use the abnormal earnings growth model to calculate the long-run growth rate in abnormal earnings growth that is implicit in the stock price as of year 0. The stock price in year 0 is given, and it is equal to 150. Abnormal earnings growth is assumed to grow at a constant rate g from year 3 onwards, and this g is our unknown. The value of equity in year 0 is equal to capitalized earnings in year 1 plus the sum of discounted capitalized abnormal earnings growth from year 2 onwards, including a growing perpetuity terminal value term. We can solve the equation to calculate g, and this is equal to 0.072. So 7.2% is the growth rate in abnormal earnings growth that investors expect. If we believe that the future growth in abnormal earnings growth is higher than what investors expect, then our conclusion is that the stock is undervalued. And if we believe that the future growth in abnormal earnings growth is lower than what investors expect, then our conclusion is that the stock is overvalued. In an earlier video, we had assumed a 5% growth rate in abnormal earnings growth from year 3 onwards. In such case, we would conclude that the stock is overvalued because investors overestimate the growth rate in abnormal earnings growth, 7.2% versus 5%. The stock recommendation would therefore be to sell. The focus of analyst forecasting is earnings and not abnormal earnings growth. Therefore, it would be more useful if we used the abnormal earnings growth model to generate the implicit growth rate in earnings as opposed to the implicit growth rate in abnormal earnings growth. To do that, we need to follow the next steps. Using the implied growth rate in abnormal earnings growth of 7.2%, we can calculate the implied abnormal earnings growth forecast for year 4. This is equal to 0.09, the abnormal earnings growth forecast for year 3, times 1.072. This gives an abnormal earnings growth forecast for year 4 equal to 0.096. We then calculate normal earnings in year 4 as 12.73, which is the earnings in year 3, times 1 plus r, which is 1.1, and this gives 14.003. Using the formula for abnormal earnings growth, we can now calculate cum dividend earnings. Normal earnings plus abnormal earnings growth in year 4 is equal to the cum dividend earnings in year 4. That is 14 plus 0.096 is equal to 14.099. The earnings on the dividends in year 4 is calculated as 9.93, the dividend of the previous year, times the cost of equity capital 10%, and this gives 0.993. Cum dividend earnings is equal to earnings plus earnings on the dividends of the previous year. So we can calculate earnings in year 4 as cum dividend earnings minus earnings on the dividends. This is equal to 14.099 minus 0.993, and this gives 13.106. Having calculated earnings for year 4, we can calculate the growth rate in earnings implied by the market between years 3 and 4. This is equal to 13.106 divided by 12.72 minus 1, and this gives 3%. If we believe that the earnings growth will be higher than 3%, then our conclusion is that the stock is undervalued and our stock recommendation is to buy. If we believe that the earnings growth will be lower than 3%, then our conclusion is that the stock is overvalued and our stock recommendation is to sell. We can continue our calculations and use the implied growth rate in abnormal earnings growth of 7.2% to calculate the abnormal earnings growth forecasts in the subsequent years after year 4. Using the abnormal earnings growth formula and the steps that we followed before, we can infer the corresponding earnings forecasts and the implicit earnings growth rates. You can see on the slide the case of Reebok, and that the market expects earnings growth to decrease over the years from 11.08% in 2006 down to 10.19% in 2012. Once again, if we believe that this growth pattern underestimates the true growth potential of the firm, then we may conclude that the stock is undervalued and we may buy the stock. If the opposite is true, then we may conclude that the stock is overvalued and we may sell the stock. This is another exercise where we are asked to calculate the implied cost of equity capital using the abnormal earnings growth model. The following information is given and we are asked to assume that abnormal earnings growth will grow at a constant rate of 3% from year 2 onwards. The current stock price is 147.2. We can use the 2-period abnormal earnings growth model formula. That is, we capitalize next period earnings and also discount the capitalized abnormal earnings growth in year 2 with R minus G. Abnormal earnings growth is defined as cum dividend earnings minus normal earnings. Everything is known except the cost of equity capital, so we can do the math and solve for R. This is equal to 9.36%. If we think that the cost of equity capital of 9.36% overestimates the risk of the stock, then it is likely that the stock is undervalued, and if we think that the cost of equity capital of 9.36% underestimates the risk of the stock, then it is likely that the stock is overvalued. This slide shows the calculations how we got an implied cost of capital of 9.36%. I encourage you to practice those at home. We have mentioned before that in theory, the higher the risk, the higher the expected return, and hence, the higher the average future stock return. The implied cost of capital is a measure of risk that is priced by the market because it is calculated based on observable market prices. So in theory, the higher the implied cost of capital, the higher the average stock return. Practitioners have been using implied cost of capital measures to predict future stock returns, and what they do is they buy stocks with high implied cost of capital and short stocks with low implied cost of capital. This hedge portfolio strategy has been tested empirically by several papers. Goad and Mohanram in 2004 used the abnormal earnings growth model with a 2-period forecast horizon to test the return predictability of the implied cost of capital. They used the following formula: price is equal to capitalized forward earnings plus a discounted perpetuity terminal value term starting from year 2. After rearranging the formula, Goad and Mohanram come up with an expression for the implied cost of capital as shown on your slide. They use the risk-free rate minus 3% as a proxy for the long-run growth rate in abnormal earnings growth across stocks. To estimate future earnings, they use analysts' earnings forecasts, and to estimate future dividends, they use the current payout ratio. I have estimated the implied cost of capital as suggested by God and Mohanram in 2004, and I formed the proposed hedge portfolio strategy using companies listed in the US stock market, NYSE, Amex, and Nasdaq. I sorted the stocks based on the implied cost of capital every year, and I calculated the 12-month ahead average stock return. You can see that as we go from low implied cost of capital to high implied cost of capital, the average future stock return increases almost monotonically. So we go from 0.93% up to 1.97%, and if we form the hedge portfolio strategy to buy stocks with high implied cost of capital and short stocks with low implied cost of capital, we earn a hedge portfolio return of 1.04% in the time period that I used. This is statistically significant, and the annual Sharpe ratio is equal to 0.57. On this slide, you see the performance of the hedge portfolio strategy over time, over the period from 1970 up to 2013. And you can see that this is a risky strategy with high volatility. And this is expected because when we buy high implied cost of capital stocks, we buy high risk. In the special case when abnormal earnings growth is expected to be constant from year 2 onwards, the stock price becomes equal to earnings per share in year 2 plus R times dividend per share in year 1 minus earnings per share in year 1, and all of this divided by R squared. After rearranging the formula, we get an expression for the implied cost of capital, which is equal to the square root of earnings per share in year 2 plus R times dividend per share year 1 minus earnings per share year 1 divided by the current stock price. If we further assume that dividend per share in year 1 is 0, which is not a bad assumption given that most companies in the US pay no dividends, the formula for the cost of capital becomes even simpler. This is the square root of earnings per share in year 2 minus earnings per share in year 1 divided by the current stock price. So if you can forecast the earnings of a company for the next 2 years and you can obtain its current stock price, you can come up with a proxy for the company's cost of equity capital very easily. You can also use your estimate of cost of capital to predict future stock returns, and this is done by Easton in 2004. On this slide, you see the average future stock returns for 10 portfolios formed on the basis of implied cost of capital as suggested by Easton in 2004. Implied cost of capital is computed as the square root of earnings per share in year 2 minus earnings per share in year 1 divided by current stock price. You see that as we go from low implied cost of capital stocks to high implied cost of capital stocks, the average future stock return increases from 0.9% to 1.96%, and the average hedge portfolio return in the period is equal to 1.06%. These results suggest that even if we simplify the abnormal earnings growth model by assuming 0 dividend payments and 0 growth in abnormal earnings growth, the return predictability of the implied cost of capital remains strong. Here you see the performance of the hedge portfolio strategy over time, over the period from 1970 up to 2013, and you see that the strategy remains profitable and impressive.